Hi, can you hear me? Is everything good?
Yeah, we can hear you perfectly, Chuck. It's just that we are gonna do a sound check before we start so that we know that the sound levels are in line.
All right. Well, I really appreciate you guys inviting me to be on here, and I look forward to participating in your podcast.
We are stoked.
Excellent.
Denne podcasten og innholdet skal ikke anses som investeringsråd. Hensikten med podcasten er å bidra med informasjon om finansmarkedene og selskaper. Podcastvertene er selvlærte hobbyinvestorer og ikke finansielle rådgivere. Informasjonen som gis i podcasten utgjør kun våre personlige meninger. Hvis du legger vekt på noe du har hørt her, gjør du det på egen risiko. Verdipapirer som diskuteres i podcasten skal ikke forstås som en anbefaling til å kjøpe, holde eller selge nevnte verdipapir. Podcastvertene kan være direkte eller indirekte eksponert mot verdipapirer som diskuteres.
Listen, guys, we are proud to introduce a special guest for our listeners. He's the creator of F.A.S.T Graphs, the fundamental stock analyzer software tool. He's a contributor and author of hundreds of articles for many financial websites, such as Seeking Alpha, Forbes, The Street, Advisor Perspectives, Core Compass, and Safe Haven. F.A.S.T Graphs is a very powerful stock research tool that provides a financial, clear historical perspective of the company's normal operating results and prices or valuations. Mr. Chuck Carnevale, welcome.
Thank you. Thank you. Great to be here.
So, Chuck, we are really pleased that you accepted the invitation to come on board with us. Could you just give the listeners that don't know you some insight about your background and what led you to become such a popular figure among value-seeking retail investors all around the globe?
Well, I've been in the industry since 1970, so I just aged myself, of course. But investing has always been my passion, even as a high school student, and I of course studied it in college. And one of the interesting things about how F.A.S.T Graphs was born was my college professor, economics professor, used to literally pound the table or his desk with his fist, and he would say, when we were talking about analyzing stocks, he would say earnings determine market price. And that kind of became a passion. He had a study that Pershing had conducted, and they showed the correlation of that time the S&P 500 going back 50 years and the earnings of the S&P 500. And the correlation was phenomenal when you could clearly see overvaluation and undervaluation periods, which help you make decisions on, say, when, for example, when would be the best time to invest in the S&P and when would be a bad time to invest in the S&P. So I wanted to see that same correlation on individual stocks, and that's kind of how F.A.S.T Graphs were born. And we use them in our in-house money management firm, which, by the way, we named EDMP, which was earnings determined market price. And then its evil twin sister is emotions determined market price in the shorter run, but earnings determined market price in the long run. And it's just been my life passion. And through my writings, especially actually on Seeking Alpha, maybe especially, I was always talking about valuation and always harping on the importance of it. And I'll talk more about that as the podcast continues. But one of the keys about valuation is that if you get it right, or even reasonably right, then it allows you to fully participate in the company that you're investing in. And most people, buy a stock because they admire it for some reason or another. And, so if that's what you're doing, you want to basically be able to participate fully in what that company is capable of generating on their stakeholders' behalf. And if you overpay, you end up doing less. And of course, if you underpay, you can actually even do better than the company. So that's kind of just been my life's work. And, F.A.S.T Graphs has evolved over the years. But basically, we originally were only looking at earnings. Now we look at numerous metrics: EBITDA, EBIT, sales, cash flows, free cash flows, and so on.
Yeah, that's excellent. I really like the names of the, of the funds. That's
Tried to have a meaning, behind all of them. Something that people could relate to if they understood what it was.
yeah, exactly. So, what type of valuation method do you typically like to use?
Well, we fundamentally look at. Well, I shouldn't say fundamentally look at fundamentals, but we're basically trying to measure stocks based on their fundamentals. Now, some stocks, earnings would fit real well. And other stocks, we would look more closer to cash flow. Amazon's a good example of that. But we try to don't limit it to one metric. We try to cover every metric you can. My concept is that valuation is a puzzle. And like all puzzles, you got to have all the pieces in the puzzle to make the beautiful picture. And so, we don't stop at one, and we look at operating earnings, we look at GAAP earnings in the US here, diluted earnings, that's referred to. We look at operating cash flow, free cash flow. We look at EBITDA, earnings before interest, taxes, depreciation, and amortization. We look at valuation relative to EBIT, and then finally, even valuation relative to sales. And based on how those things all basically check out, then it allows the investor or the subscriber to make an informed decision as to what they're doing. I like to call it investing with your eyes wide open. It's one thing to find and identify the best companies, but it's another thing to know when to buy them, when to sell them, or when to hold them. And F.A.S.T Graphs, I think, offers that ability better than anything that I'm aware of. And I originally greedily created it for myself, but then we turned it into a something that we offered to the general public about 7 or 8 years ago.
I know that your tool is quite magnificent because we are value-seeking investors, and I use actually the same metrics that you do, but I do it manually, and it if I used F.A.S.T Graphs, it would save me 2-3 hours of research just based on quarterly reports and so on. So it's a huge help for retail investors. Saves a lot of time.
Yes, and by the way, we also have designed a tool so that you can go deeper under the hood. We have the financial statements from all the companies, for example, available to our premium subscribers, and we can look at them graphically and so on. But our idea is this should be the first step, before a comprehensive research process is conducted, because to us, or at least to me and us, our team, it doesn't make any sense to spend those hours that you just referred to trying to research a stock just to discover it's overvalued and not investable at this time. So, it's all about saving time, saving effort. I like to say F.A.S.T Graphs are the value investor's best friend. And the idea is to make investing fast, fun, and much more efficient is the whole key. Because we all have one limit we all have is time.
Yeah, that's a good point right there. Could you tell us what got you into finances in the first place?
But just curiosity, investing. I've just always wanted to do something with my life. I come from a blue collar family, and this is kind of I shouldn't tell this story maybe, but my dad was a plumbing contractor, and he had a sign on his truck that said Carnevale and Sons Plumbing. And I told him to take the S off of Sons because the one son wasn't going to be a plumber. And I was going to go out there and make something of myself. And finance just was something that intrigued me. I've always been kind of philosophical in nature. I ended up with minors in economics, finance, psychology, and English lit, to be more precise. So I kind of like philosophical ideas, more than I did mechanical things like, how I would plumb a house. That wasn't too interesting to me. And then actually in college, my professor, I think I should add this, that when he showed me that study, that's literally said, that makes just so much sense to me. But I couldn't find that information anywhere. So F.A.S.T Graph was born.
That's a great story, and I don't. I think everybody should find their own path. Yeah, within without the kind of the vision that the parents want to pass on, if you know what I mean. So I think it's great that you disrupted from your father in one sense, with all due respect.
So he still got one of his sons doing it. But one of the things I've taught my children and grandchildren at this level now is, I consider this to be one of the most important pieces of advice anyone can get, and that's, as you said, find your passion, so that you can, love what you do what you love, and you never have to work another day. And that's, to me, one of the keys to being able to be successful, no matter what that passion is. If you love it, you're going to put in the time, the effort, and the thought processes to, to make it work. And to me, unlocking the puzzle of, when is a business investable and when it's not is just something that just intrigues me. And it's something that I actually consider it fun. And again, but any job is better when you have the right tools, or easier when you have the right tools. And that's why, a lot of the tools weren't available to me. So like any aspiring entrepreneur, I created the tool when F.A.S.T Graphs was born. Very blessed, and we're very grateful to all our subscribers. And, my wife is real fond of making a statement. She says, like all things in nature, when you quit growing, you're in the process of dying. And we've continuously evolved F.A.S.T Graphs over the years. We've now just come up with a portfolio management system. Again, we added the financial statements, and, we're not stopping there. Every day we're trying to get a little better than we were the day before.
So for the Norwegian listeners, because we are primarily our listener base is based in Norway. So have you added to the Norwegian market so that people can look up stuff or stocks from Norway on your F.A.S.T Graphs software tool?
Yes, in fact, about a year ago-ish, I don't remember the exact date, but about a year ago, we added international stocks. So currently, we have, F.A.S.T Graphs available for roughly 80,000 symbols. And more importantly, maybe not necessarily more importantly, but more to the point, the subscriber can actually choose the currency that they want to look at the company in, whether it's, US dollars like I do most of the time, or the currency of origin, and they have the choice to do that and change it. They can go back and forth into whatever currency they want to look at. And the reason that's beneficial, by the way, is because it allows you to evaluate currency exchange rates and how they might impact, operating results over time. So yeah, we have 80,000 stocks, and we would have all the major exchanges worldwide.
Yeah, that's great. And you know, Norway is known for its oil and salmon. And the thing is, they are kind of 90% of the stocks in the Oslo Stock Exchange is cyclicals. How do you evaluate them, and how do you avoid value traps? Because when you have peak oil prices, all of the oil stocks seem cheap based on the PE ratio.
Right. And that applies to almost every sector and every industry, worldwide. But cyclicals are really no different than, let's say, a consistent, steady grower. Um, the real key to valuation, in my perspective, is trying to measure what those cycles are going to be and what length they're going to be. And F.A.S.T Graphs very clearly illustrates, when a stock is trading at a very high valuation relative to its norms. And cyclicality, things like cyclicality, are also a very nebulous concept, because there's, you know, mildly cyclical, largely cyclical, semi-cyclical, so the point is that in almost all aspects, though, even cyclicals tend to grow their businesses over time, but they do it by, peaks and valleys, if you will. It's more like almost a staircase than it is, let's say, a straight line, like certain companies in certain industries, just generate, earnings growth year after year after year. So, what you do is you simply draw the F.A.S.T Graphs from the large perspective and try to ascertain what the cycles look like. And by just simply running your mouse across the price, we go back 20 years on data, by the way. You can look at what normal and what, high and what low valuations have been on whether if you're looking at earnings, of course, you're looking at PE ratios. But from a standpoint of value investing, I think this is one of the most important aspects of that. You can never buy the past. In fact, some of the stocks that you guys asked me to look at, we'll talk about that in more detail here in a second. But you can learn a great deal from the past, but you can only invest in the future. And so what you need to try to do is figure out where the company's going in the future, and then try to discount cash flows back to the present value, which is already built in essentially. That's how F.A.S.T graphs function. And then another thing I think that's critically important, depending on what type of investor you are, dividends tend to be a lot less cyclical, for example, than either earnings, and certainly less than stock prices. But cyclical stocks, their stock price will follow the cycles. And you can see that vividly when you look at a F.A.S.T graph. And when the cycle's hot, the stock will be hot. When the cycle's, in a downspin, the stock price will usually, fall. Now the valuations can adjust to that, because obviously if a company had, say, $1 worth of earnings last year and they were selling at 15 times earnings, they'd be selling at $15. If earnings have fallen to 50 cents, then obviously, they'd be selling for $7.50, but their valuation would still be the same. But with F.A.S.T graphs, you can see those peaks and valleys clearly and make your decisions on appropriate times to buy, sell, and hold. And I think it's also important to add here, valuation is not precise. Valuation is always a range. And and so it comes down to, if you're looking at earnings or cash flows, it's earnings yield or cash flow yield. And what that simply is the inverse for, well, you stick with the PE ratio to keep it simple. PE ratio is price divided by earnings. Earnings yield is earnings divided by price. And what you want to do is calculate the earnings yield presently, and then also try to have some sense of what the earnings might do going forward, and then make sure you're getting an earnings yield of the, and about 15 PE is 6.67%. You want that earnings yield to at least be at that level so that you're being compensated for the risk you're taking. And the other thing is, cyclicals can be good buy and hold stocks if you buy them at the low end of the cycles. And you can identify and recognize those very easily. Well, I don't want to say easily, but vividly, within reason. Because again, everything is within a range of reasonableness.
Yeah, and with the cyclicals, it's also difficult if they are linked to a commodity price, for instance, like oil and stuff, and you have to have an opinion on the outcome of that.
They're more difficult to invest in, but they are investable. And I think that's the key. And again, most of the like the oils, most of the oils come with a dividend attached. And I want to just reemphasize that, because I alluded to it. You can look at the income stream, and then you can measure what it would be considered an attractive dividend yield for that particular company and or that particular industry, and make sure that you're also, which by the way correlates to earnings yield very, very closely. You want to make sure you're getting compensated for the risk you're taking. And by the way, if you're a buy and hold investor like I am, this is something that I think a lot of people overlook. I think I'm the one that coined this phrase, but I said that all great investors and great mountain climbers share a common understanding. They both recognize that the only way to get to the next highest peak is to be willing to navigate the valleys that are going to come in between, and the unavoidable valleys that are going to come in between, I might add. And so, again, it is a stair step. Even cyclicals, will grow, but they do it in stair steps rather than, like clockwork, so to speak. But by focusing on earnings yields and, the length of cycles and things like that, you can still make rational decisions so that you can participate fully in the, what the company delivers by, getting a good entry point. And a good entry point is not buying at the absolute low. They don't ring bells at tops or bottoms. You got to buy when it makes sense, when there's, prudent economics supporting your decision, in my opinion.
But let's say if a company has a high return on invested capital or return on capital employed, depending on what parameter you want to use, wouldn't you say it deserves a higher multiple, and therefore the earnings yield will be lower for the future growth?
That's a really excellent question, and it's almost a soapbox of mine. I don't think there is such a thing as a company deserves a higher multiple. it really comes down to trying to measure the amount of cash flow that you can get, whether it comes in cycles or whether it comes in, a steady stream, like I mentioned several times. But valuation is really all about the cash stream or the income stream. And by the way, cash flow, earnings, EBITDA, all these sales, all these things are measuring the same thing, just in a little different format. It comes down to what is the business capable of generating on behalf of its shareholders. So multiples now, a faster growing company is deserves a higher multiple. That's where Peter Lynch, for example, coined the phrase P equals growth rate, and the PEG ratio was born out of that. So if you got a 25 or 30% grower, it does make sense to pay 25 or 30 times earnings for that. But companies below 15%, the law of compounding really has a great deal to do with this and the time use of money, because when you say the word deserves a higher multiple, to me, there's no such thing. It's that cash flow stream has value, and what I want to do is make sure I'm buying that cash flow stream at a value that's prudent, and again will compensate me for the amount of risk I'm taking. So the reality is every stream of income is worth a multiple of itself. In other words, no one would sell, say you paid $1,000 for a bond paying 10%. You wouldn't sell me the bond for $100. That'd be one times interest. So there is a kind of a number there. Now Ben Graham and his formula, the Graham-Dodd formula that we use on F.A.S.T Graphs, he said like a minimum threshold there, I think he said was 8.5 times earnings. He also taught us never pay more than 15 times earnings for a company. And by the way, that remarkably applies to companies up to about 15% growers. Now, once you get above that level, it turns out that the P equals growth rate formula begins to make a lot more sense. But I do want to keep, reiterating what I said earlier, and that is there is no such thing as a perfect number here. These are all valuation references, and what you're trying to do is determine a prudent and sensible way, or excuse me, entry point to invest, where you also have a margin of safety, where you're going to be adequately compensated for your risk you're taking. And by the way, the higher the margin of safety, the better. But that's in a market like we've had in the United States, for example, since the '08 recession, is just it's one of the longest running bull market we've ever had, and that stock prices are extended on most industries and most companies. So valuation is very hard to find in a bull market, but it's prevalent in a bear market. But valuation is all about you participating and valuing a future stream of income that that back to the present value, so that you're saying, okay, this makes sense, this investment makes sense for me. But I don't think they deserve higher multiples or lower multiples. I think they deserve a prudent multiple, and that would be true of all companies. I don't know if that answered your question or not, but that's my take.
Yeah, that's an excellent answer.
I'm sorry, I've got a frog in my throat all of a sudden, guys. But when you see it, kind of you believe it. In other words, it's a lot more visual. Where in a podcast like this, it's kind of hard to articulate what I'm saying here. But the bottom line is you can see it very clearly when you focus on correlating valuation to fundamentals. That starts to make sense because you start to understand the business behind the stock, and that's one of the things that I'm so proud of with F.A.S.T Graphs. It does that as well as any tool that I've come across anyway.
Yeah, I agree.
The faster growing companies do deserve a higher multiple because they're going to generate a larger stream of income. I want to try to clarify that. Slower growing companies deserve a lower multiple because they're going to generate a smaller stream of income. But there's a baseline for all companies. Even zero growth is worth a multiple. And by the way, multiples don't determine the rate of return. I think that's another important point that people miss. Multiple, valuation is really a measurement of soundness or prudence and risk. And where the return is going to come from is going to be relative to the amount of growth of earnings, growth of cash flows, growth of dividends, and the magnitude of that or the rate of change of that over time is all going to be determined by what the future growth is. That's where your rate of return comes from. Because, for example, you buy a 5% bond, you don't expect to make a 10 bagger. Okay, you buy a growth stock like Amazon, you might, you expect to make, double or triple or quadruple your money. But in both cases, they have a value that is minimum. And valuation is all about a value that the buyer is happy buying it at and the seller is happy selling it at. In other words, it should always be valuation should always be measured kind of as a win-win proposition where everybody essentially wins. And I can articulate more on that if you'd like. But
Yeah, but that was a great answer, and I think the point is really well articulated. So I was just touched in on bonds. We had a question from one of the listeners that wanted to ask you if you've done anything differently now that the Fed fund transit is 5.5 and you have 10-year, 20-year yields above 4, or is this the same 6.5 or 6.75 earnings yield that you're
to
searching for?
me, I'm sorry, I didn't mean to interrupt you. Did you finish? Did you ask your question? I think I heard it.
Yeah. Go ahead.
The question is what impact do interest rates have, on valuation and making your decision? And I think what people forget is interest rates are an exogenous item. They're a cost of business and depends on the industry. Like a real estate investment trust, real estate or interest rates will have a bigger impact than a company, for example, that has no debt. All right. So interest rates don't really matter. It's the cost. And just like you mentioned, oil and commodities, if if the price of your commodity rises or falls, then management has to build that in to their model, to their profit and loss model. They have to raise their prices or lower their prices accordingly to, generate demand and be able to feed the supply. So the idea here is interest rates are just another cost of doing business. If interest rates get higher, for example, if you're talking about real estate, it's a little clearer to understand. You adjust your cap rates when you're looking at buying or selling a piece of real estate, whether you're a buyer or a seller, in other words, based on what the reality of what current interest rates are dictating. But it doesn't really change the valuation because what it can change is, for example, the future level of those cash flows I mentioned earlier. And again, I want to make sure we're using that word generically. That could be measured as earnings, measured as cash flow, measured as EBITDA, measured as, whatever. But the point is that income stream could be affected if the income stream becomes significantly lower, slower, or lower or smaller because interest rates have gone up, then they have a major impact. But if it doesn't affect the income stream of the company at all, then it should have no impact on their valuation. And again, that would be a classic example would be a company with no debt. What do they care what interest rates are? It comes down to what their weighted average cost of capital is and what their return on invested capital, can be. And those things become much more important than exogenous, issues like interest rates. Warren Buffett once did a really great piece, and I don't have it at my fingertips here, but I can paraphrase it. And I think he wrote this in 1970 something or other. And he said something about, we will continue to ignore um, macroeconomics and political, discussions because we know nothing about those things. And he summarized the whole thing. He said, "Surprise, surprise! Nobody could have foreseen the oil shocks, interest rates rising to 22%." And again, I'm paraphrasing this. I'm not saying it. I'm not repeating it fully, but he ended up by saying, "Surprise, surprise! None of these catastrophic events made even the slightest dent in Ben Graham's, investment principles." And again, these things are costs of doing business. They're, when you're, when the price of labor changes, when the price of interest changes, when the price of commodities change, management teams have to adjust and adapt those things into their, into their profit and either raise prices or lower prices or do something to become more efficient, to lower costs and be able to maintain their their growth and their business levels. But to the extent that it affects growth, that's the extent that it really has an impact on what, your value is going to be out of that. But keep in mind, valuation is prudence. It's not rate of return. Rate of return comes from how much growth you're able to achieve.
Yeah, that's excellent. So I wanted to pivot over to, you touched a bit on it before we go over to the companies that you took a look at before the episode. The last
Sure.
question is, what do you think about the valuation of the markets right now, the American market?
Well, one of my favorite phrases, as I always say, it's a market of stocks, not a stock market. And, I don't try to deal in generalities. I try to be in specifics. I also coined a phrase that said mind, MIND, your owned, OWNED businesses. In other words, I'm much more interested in trying to ascertain what the individual businesses I'm either invested in or considering investing in than I am trying to worry about macroeconomics, because it's just, it's a kind of an esoteric philosophical subject that doesn't necessarily always apply. So, it's a market of stocks. I look at the individual stocks. In every bull market, there are stocks you can buy at good value, and there are also going to be overvalued stocks. In every bear market, there's going to be overvalued stocks and undervalued stocks. You'll get more value in a bear market than you will in a bull market, of course, but it's always there. It's always a conglomerate of a bunch of companies being mixed together. So I don't try to get too involved in macro as much as I'm really interested in how are my businesses doing, and what are their prospects, and what are the drivers of return that those businesses have. And that could be, they have a niche, they have a patent, they have a pharmaceutical has a new drug that they're launching. Those are the things that become much more important, and the rest of the stuff is you depend on management to kind of value those things or price those things, if you will, so that they can make the money that you expect them, that company or business to basically generate. In my take, it's my opinion.
Yeah, that's great. I was hoping you'd say that. So maybe with that we can go over to yeah, seen a lot of your videos, and the market of stocks thing is a staple of yours.
I do think the S&P 500 is trading at one of the highest multiples I've ever seen it trade at. It's also growing a little faster than, expected to grow a little faster than it historically has. But I do think it's out of whack. I think valuations are still too high. But again, there's 500 stocks in that index, for example, and there's 100 or more of them that are still attractive, even though most of them are overvalued. Just to put that into further clarity. Sorry, I didn't mean to interrupt.
No, no, that's fine. So we could take a look at one of the companies. I believe you own it, Amazon.
Yeah, now Amazon is a classic example of one of the things I kind of alluded to earlier. Earnings determine market price, and that's true of the vast majority of companies. And I think, as rational thinkers, we should all realize that there's a exception to every rule. Okay, and it's not that Amazon is the exception. Jeff Bezos, when he formed this company, I think in his very first letter to shareholders, told everybody he wasn't going to make any profit, but he was going to generate. I'm using my own words, not his. He was going to generate bucket loads of cash. Okay, because what Amazon has done, of course, is started out as a bookseller, and then turned that into, they sell everything there is to sell in the world. And you can even buy a house on Amazon. I don't know if you knew that or not. And, so it's just, really become an incredible company. But cash flow has been a tremendous a tremendous correlation to stock price. And, the company's grown cash flow since 2004, which is, or the beginning of 04, which is as far back as I go on F.A.S.T Graph, at just under 29% a year. And by the way, their performance during that time frame, because again, Amazon does not pay a dividend, has been 23.5% versus 8%, for example, in the S&P 500. Classic example of it's a market of stocks, not a stock market. So, what do I care how high the market is? Amazon looks very inexpensive today based on on operating cash flow. And, it's trading at a price to operating cash flow of about 20, but it's growing at, 28, 29% a year. So it still looks very, very attractive to me. Now, I do want to add, though, historical growth has been 29%. Future growth is expected to be 23%, which is still extraordinary. But that's where you get into the Peter Lynch, price to growth kind of multiple. And so at a 20 multiple, it would technically be undervalued because it would theoretically have a prudent valuation of 23 times cash flow. So I like Amazon. I'm long Amazon. I should say that. And for those of my clients that like growth stocks, I think Amazon is a quintessential example. It's AA rated, and by the way, has very, very modest debt. So it's another issue where interest rates aren't really a factor here. It's really, how they can continue to reinvest and, add additional businesses. And, it's pretty remarkable for a $2 trillion company, to be able to continue to grow at that rate. But I like Amazon a lot, even at these prices, as a growth stock with more risk than, you find with a dividend payer, for example.
So how do you feel that Walmart is growing their e-commerce part with a compounding average growth rate of around 21% annually since 2021? Could that disrupt or perhaps slow Amazon's top line growth?
I don't think so. In fact, it's usually that question is asked in the opposite way. It's, well, how bad is Amazon hurting Walmart and Target and companies like that? Walmart is a $480 billion market cap, 540 billion total enterprise value, 43 billion, almost 44 billion. But Amazon is obviously way bigger and way younger, if you will. And the expectations for Walmart at its size is based on on leading analysts reporting to F.A.S.T that are looking only for a 9% growth going forward. Again, I want to reiterate, you can learn from the past, but you can only invest in the future. So they're bringing 8 or 9% growth to the bottom line, and I think at a 27 multiple of earnings right now, I think Walmart is very expensive, but I don't think they're a real threat to Amazon. And by the way, I don't think Amazon's necessarily a real threat to Walmart. I think there's room in industry for all of them. But a good
Yeah,
question.
yeah. It was a good answer because I'm long Walmart and I really like what they're doing. I've been a shareholder for a couple of years and I think the management is doing great and I agree to some extent that you can't. They are not peers per se because one is more like a tech. Tech kind of e-commerce retailer, while the other one is a store for value.
But I do think Walmart at these levels, I will say, just as Mr. Valuation, I think Walmart is not really investable today. I think if you'd have bought Walmart 7, 8, 9 years ago, I'd be holding it, but I'd be careful putting money in Walmart today just based on valuation. But yet, but by the way, that has nothing to do with the company. If you look at Walmart, for example, going back to 2004, it was trading at a 27 on February 13th, 04, it was trading at a 27 multiple, 27.56. Today it's trading at 26.74. I would call that about the same number. And it was growing actually slightly faster back then. But if you'd have, if you'd have bought the stock in, let's say, February of 2004, their earnings, and they have a fiscal year in January, by the way, their earnings in 05 would have been 19%, fiscal 05, 11% in 06, 8% in 07, 9% in 08, 8% in 09, 7% in 2010, and then 11% and then 10%. So those are fabulous numbers. In other words, the company's earnings grew beautifully. The dividend increased from 17 cents a share. This is all split adjusted to over 50 cents a share. The problem is, though, had you bought and held that stock through, let me try to find February here, through February of 2012, your average rate of return, including dividends, would have been 2.66%. And the message that I'm trying to deliver here is Walmart was a fabulous company during that time. They grew and ran their business impeccably. And everything about them fundamentally was strong. The only thing wrong was the valuation was too high. And we're looking at a very similar valuation today. Now, am I forecasting that to happen? History to repeat itself? No, I don't know what the answer is. I just know that if you're investing in Walmart today, you're paying a premium. Where if you invest in Amazon today, I think you're actually buying it at a discount. And all of that is predicated on the reality that the growth rates that that these analysts are sharing with me and that I'm, expecting out of both companies actually happen. And, we're looking at Walmart to grow at 9% a year, and we're looking for Amazon to grow, a lot faster. But, that's easier said than done, I guess, guys.
Yeah. I think that's a nice summary. But Amazon, when you are saying it's likely undervalued, is it based on PE ratios or the free cash flow yields?
Based on cash flow, based on operating cash flow, because that's, if you saw the F.A.S.T graph on Amazon with operating cash flow, you see an almost perfect correlation between price and cash flow multiples. Now, if you look at earnings, that correlation is not there. Amazon looks way overvalued based on earnings. Again, Bezos actually said he wasn't planning on generating earnings. In fact, he went several years where they made no money or pennies a share. And now, we're looking at the company earning $4 or $5 a share going forward into 24 and beyond, even up to $7 or $8 a share. So it's finally starting to make some money, but it's, there's talk of them paying a dividend now. It's like all big companies, once a company gets a certain size, it gets very hard. Buffett talks about this all the time with Berkshire. It gets very, very difficult to find, investable areas that give you the proper returns that are large enough to move the needle. And that's going to become more and more challenging for Amazon as time goes on. That's advantage Walmart at this point. But again, Walmart's a brick and mortar store. They do have e-commerce. So, maybe they can duplicate that, but nobody's done it as well as Amazon as of yet.
Yeah, I agree. And then the other American stock that we wanted you to take a look at is Monster Beverage with a market cap of $57 billion. It's a consumer defensive non-alcoholic energy drinks producer. What do you rate that company?
Well, actually, now there's a classic example of the P equals growth rate formula coming into play. Historically, again, going back, as far as I go back with it, at my tool is January of 04. Earnings, and I'm looking at operating earnings now. Earnings have grown at just under 32% a year. That includes estimates for the next couple of years, by the way. So, and the company's stock price has tracked that growth almost perfectly. And again, I wish I could put these pictures on the podcast, because if you look at Monster now, Monster looks fully valued today, not overvalued. By the way, something about we draw an orange line on a F.A.S.T graph. I call it a valuation reference line. It's kind of like the midpoint of value. It's low value would be 10-20% less, and high value would be 10-20% high, but they would still all be value. And I would call Monster today fully valued on a historical basis. But now here's the rub, and this is the point I tried to make earlier. Forecasts for Monster, and keep in mind they don't have the flexibility that an Amazon or even a Walmart has. The forecast for going forward is about 13 to 14% growth. That's for the next 2 or 3 years, and about the same the analysts are given the same estimates. And it's a pretty widely followed company. There are 23 analysts, and I'm getting my data from F.A.S.T, and these are analysts that they've pulled, and the company's giving guidance that's basically pretty much in line with this growth. And the analysts have been very, very accurate in forecasting Monster Beverage. We have an analyst scorecard that scores how accurate analysts have been when they made a forecast 1 year in advance, and how accurate they've been when they made a forecast 2 years in advance. And we give a 20% margin of error for the 2 year and a 10% margin of error for the 1 year. And they have beat estimates on the 1 year 17% of the time. They've hit them 67% of the time, and they've only missed analyst estimates 17% of the time. Now, that doesn't mean that record will continue, but it does give a good indication that, to me, analysts get most of their forecast comes from attending analyst days, and it comes really, relates to what kind of guidance the companies are giving. And so this tells me that Monster is giving good guidance. So Monster has been a great compounder historically. I think that's the point. But again, you can learn from the past, but you can only buy the future. And the future forecasts are for much lower growth, which means I believe before I would buy Monster today, I would need to see the valuation come down quite a bit. Again, down to maybe a 15 or 20 multiple. And right now you're looking at a 33 multiple, which is, to me, simply, a reputational multiple and not a good assessment of what the future is going to bring.
Can I ask you, our listeners and myself are quite fond of consumer staples. And would you define Monster at the levels like Coca-Cola and Pepsi regarding, again, I'm phrasing it, deserves a higher multiple when you compare those?
No, not if it grows if it grows at 13%. Let's just say that's a truism, okay? And it may or may not be, all right. But let's say it's a truism that it deserves a 13. Excuse me, it deserves a 15 multiple, like every other company growing at 13% does. Now, it's been a very consistent grower. People have been willing to pay a slightly higher multiple, for the company historically, but historically, they've still been paying a multiple that related to the growth of the business. So if it does, only grow at 12 or 13% a year, again, keep in mind, if you just take, a compounding table, or if you simply, just take a calculator and calculate how big the income or what level the earnings are going to be by growing at 13%, that's going to define the future stream of income that they're going to produce. And so, no, it doesn't. It deserves a multiple that relates to what that future stream of income is going to be. I believe discounting cash flow analysis is, one of the most important ways to value a business. But the inputs can be a little wacky, by the way. And I don't believe, like, for example, in terminal value, I don't believe in going out trying to discount cash flows out further than 3 or 4 years. And even that's a stretch, because who the heck knows what's going to happen 3 or 4 weeks from now, let alone, 3 or 4 years. But I think Monster's been I'm going to emphasize, been a great company. And it's deserved all the multiples and valuations that it's achieved so far. And it has generated, relative to the S&P, it's generated a 37% annualized rate of return since January 2nd, 2004, where the S&P's only generated 11%. So it deserved, with the ED attached to the word, that multiple historically, but it only deserves a multiple going forward that's going to relate to how much cash flow they generate going forward. And by the way, this doesn't mean, the thing about valuation is I don't think you're going to participate fully in the growth that Monster is going to be able to generate if you pay too high a multiple when you buy it today. You still might make money, by the way. I do a piece, I've done a metaphor with Starbucks, which is analogous, that both of them are energy drinks. That's not true, obviously, but you know what I'm saying. But if you look at Starbucks, and this is something that people don't take into consideration, Starbucks has now historically grown about 15% a year. But in its day, from 04 up through, actually, let me tell you exactly what it was. From '04 through the end of 2015, and they have a September fiscal year, it was growing at 20% a year. And prior to that, it was even growing faster. But there was a time when the valuation got up to like 50 times earnings in '05 and '06. Actually, May 5th of '06, it was trading at 58 times earnings. Coming into the recession a year and a half or 2 years later, the stock from peak to trough dropped 79%. Okay, but and you know it's 2.5 years now. You had to have a real strong stomach to to stay invested in Starbucks. But had you stayed invested in Starbucks and held it through today, okay, even though it's dropped in value quite a bit this year, if you'd have um, let me just do a rough calculation for you. My tool all of a sudden is not working, so and again, it's only as good. The job's only as easy as the tool. But if you'd have bought it and held it through today, even after the stock has dropped, with a 79% drop initially, your rate of return today, I'm having a glitch, guys. Let me try one more time because I think this is an important point I want to make here. You would have averaged just under 9% a year. Okay, that's way overpaying for the stock. I want to emphasize for a company that grew at 15% a year, you'd have still made 9% a year, through yesterday's close. But you'd have had to watch your investment drop 79% before it, rose up to that 9% number. And investor psychologists have pointed out very clearly that investors fear or hate the pain of loss 2.5 times greater than they enjoy the pleasure of gain. And so, the question is, what investor would have been able to hold a stock and happily hold? Because, by the way, the company did great during that period of time. Even during the Great Recession, they had a very mild drop in earnings. But otherwise, they were growing 40%, 28%, 20%, 60%, 13%. The company was growing extremely well, but the stock was way overvalued. The recession came, emotions drove, and to me, 2.5 years is a short term period of time. So the stock then dropped, but it was vulnerable because it was overvalued. And then earnings continued to grow, and the stock has proliferated ever since. And by the way, if you'd have bought it at that and held it to its peak in 2021, you'd have averaged almost 14% a year. So the moral of the story is you can make money if you got the growth of the fundamentals supporting you, but you don't make as much money as you deserve. Forget what the company deserves multiple. I'm teasing, guys. It's what you deserve as an investor. If you buy a stock, you deserve to participate fully in what that company is capable of generating on your behalf. And if you overpay for it, you're going to participate lower, but you can still make money. It's just not at the rate that you deserve to make, I guess is the way I'd like to put it.
I loved your point with what kind of multiple do I deserve in that company. I love that also.
Yes, it's forget about what the company does. The company deserves what it produces. You're only as good as your last. If you're a sports fan, is your last goal you scored, whether it's football, baseball, basketball, soccer, whatever it is. And there's a lot of truth to that with companies. That's why I say you learn from the past, but you've always got to be investing with your eyes to the future. And the only thing certain about the future, guys, is it's uncertain. So it's always it's always an estimate. It shouldn't be a wild guess. It should be an estimate based on gathering all the factual information you can assemble and then trying to make a rational decision based on that. And you're going to be wrong. That's why you do things like diversify and so on.
Yeah, and I think it's I think this is also why that we say that a high valuation is a risk to your capital, because if you get a 79% drawdown, but the company is doing fine, you will most likely sell, and then the risk materializes, right? You have lost
Yeah,
79% of the capital.
there's a gentleman that works in the financial planning industry. He's famous in the States here, and his name's Bob Very, so I'll give him a, attaboy. And he said something once that really impacted me. I thought it was just fabulous. He said the definition of an excellent investment advisor is one that has the courage and integrity to insist that his clients do what they ought to do rather than what they want to do. And I often talk. I do manage a small portfolio for clients, which is a secondary business to F.A.S.T Graphs. And I always say I live in money manager hell. I'm always giddy and happy when my clients are despondent and depressed, and I'm always depressed when my clients are giddy and happy. Everybody wants to buy at the top and sell at the bottom, and that's another factor of investor psychology that has to be understood. And to me, one of the most important things about investing is to answer correctly the question, know thyself. How much risk are you really willing to stomach?
Yeah, I agree. No, I was wondering if we could go across the pond to the Nordic companies that we
Sure.
pitched you before the pod, and we can start out with the Swedish giant Investor AB, which is a 854 billion SEK market cap, and it's an investment company and an industrial serial acquirer based in Stockholm.
Yeah, there's again, I wish I had the visuals to support what I'm saying here, but I can still try to paint that picture with my words, so to speak. Once again, all of a sudden my tools forsaking me. Okay, there we go. This has been we talked about cyclic. You talk about Investor AB, is that correct? Did I hear the right stock?
Yes.
Yes. All right. An unbelievably cyclical company. Now, and that's from an earnings point of view. Okay, and that's not really unusual because they are an acquirer. They do grow by adding companies. From what I can tell, and again, I'm not real intimate. The stock price has been very consistent, and the performance going back again to as far as I go back, which would be December of '03 here. The performance has been astounding. They've done 13% a year versus, like, comparing to the US S&P, 8.6%. And that's a really good number because they've turned $10,000 into 100 plus, where the market's turned it into less than 50. So it's an excellent historical company. Now, the problem I would have with this stock would be, expectations are earnings. You talk about cyclical earnings are expected to drop 78% this year in 2024. And I've already obviously reported a couple of quarters. I haven't seen the numbers, but I'm assuming they've already had some down quarters. So, the thing to be would be if 2024's estimates are correct, then somewhere late 2024 or early 2025, you might get an opportunity to invest in this company at a reasonable valuation, but that's still to be determined. But it's a double A rated company with only 9% debt, and I would say that interest rates, debt to capital, that is, interest rates aren't a major factor on this one, like we talked about earlier. But it's a company that's befuddling from Mr. Valuation to look at because it is so cyclical. But stock price doesn't seem to care.
No, yeah, they have a lot of companies and
good companies, I might add. I did go through their website, their corporate website, and they've got some really interesting businesses and quality businesses.
Yeah, they have a big stake in Atlas Copco, and that's a really giant industrial company.
But again, I can only share with you what I see because I haven't spent the hours I normally do to research a stock, these stocks at this point. But frankly, that's the least interesting one to me only from a valuation point of view. I always want to make that clear. It's not saying anything about the company. That's saying something about the stock price or the value. The other two look a lot more interesting to me at this point. Now, I'll explain why. If you want to move on, which one do you want me to do next?
Yeah, sure.
We can do Medistim. It's a Norwegian company with 3.2 billion kroners in market cap. They are the market leader in intraoperative ultrasonic guidance and quality assessment focused on improving surgical outcomes. So hit it, Chuck, with evaluations here.
Yeah, this to me is a classic example of the importance of valuation. The company's stock price from 05 through 2015, through April of 2015, traded at plus or minus a 15 multiple normally. And then starting in 2015, it started to separate from its earnings justified value and began to get really overvalued. Then in 2018, all of a sudden, the company's stock price just screamed. That there must have been some catalyst that got investors excited, and it got up to a PE of over 76, almost 77 times earnings, and that peak, based on a weekly close, was in October 15th of 2021. The stock price was trading at that point at $45.75. Actually, the high for the year was 47.58. So, but that on October 15th, it closed at 45.75. Today, or at least through yesterday's close, the stock was trading at 15.89. This is US dollars now. And it fell. It has fallen 65% in value. And if I look at it from earnings grew 20%, 24%, -2, and 40% through 2021, which is when the stock peaked. And then for 2021, 2022, and 2023, 2023, earnings dropped where the growth rate slowed down to 7%, and then they actually dropped 4% in 2023, and they're expected to grow again at 10%. But the point is, the stock has had a massive correction. And again, the company I call this one, we talked about this early in the beginning of the podcast. This would be what I would call a semi-cyclical or modestly cyclical company. And again, I'm looking at it in US dollars. Just for fun, I'm going to convert to the currency of origin, which is what does NOK stand for, guys?
Norske kroner. We will get into the currency later on, Chuck, but just keep going.
But it's the number, it's been a 12% grower, and it's since 2015 the market has been applying a higher multiple than historical norms, but now the stock is trading at that level at about a 25, or excuse me, about a 30 multiple of whatever your currency is. And it's looking at, so let's put it this way, guys, it's a heck of a lot better investment today than it was 2 years ago or even 4 years ago. But 4 years ago, it was still inexpensive from the standpoint that it had another 2 years of a run. And now for the last 2.5, maybe going on 3 years total, the stock has been in a free fall. And it's only been a result of a modest change in earnings. They want to make that clear. That's where the risk of overvaluation really comes into play. The stock, the business hasn't really deteriorated. I mean, it's slowed down a little bit. It's gone through a little bit of cyclicality here, but only modestly. And yet, it created a 65+% drop in the stock price. But again, no fault of the company. It was strictly a fault of, like Warren Buffett says, price is what you pay, value is what you get. And, the value simply wasn't there, even though the company was still growing. It did not deserve, it did not deserve the multiple that it was trading at in 2021 and even 2019. But it looks a lot better today. But I think for me, it wouldn't be investable yet, but it's a lot closer today than it was, 2 years ago. I wouldn't sell it if I owned it at this point, but I probably wouldn't buy it, if I didn't own it today.
What is the blended PE of Medistim right now?
30.73. And
And
29.48 has been the normal PE since 2012.
so
But
what kind of price target gives you a margin of safety on Medistim?
well, you're not going to like the answer, but I'm going to give it to you. I'd be looking at the stock, trading around in your currency about 87 or 8 before I'd be
Yeah.
interested.
And that's based only on PE?
Yeah, it's based on price to earnings. Yes, on what I would
Yeah.
consider a normal, or rational price to earnings. Now, I could stretch that number up to, it would be at a reasonable value at 130. It's at 177. It would be a margin of safety value at around 87 or 8. And that would be a good time to be entering the stock, in my opinion. And it's looks like it's headed that way, but it's been heading that way for the last 3 years. And remember, it's never a straight line; it's always a jagged line. When stock rises or falls. Again, the
Of
mountains,
course.
the peaks and valleys are always going to be there, and it's they don't ring a bell at the top or bottom of a market in any exchange.
And over to the next one, Borregaard, with a market cap of 19.1 billion kroners. It's one of the world's most advanced and sustainable biorefineries by using natural sustainable raw materials. They produce advanced and environmentally friendly biochemicals and also hold strong positions within ingredients and fine chemicals. What do you think about Borregaard? It seems like a non-cyclical company, even though it's in a cyclical business. Am I right?
I would call it a quasi-cyclical. Okay, for example, what I mean by that is, the company had pretty good earnings growth from. I only go back to 2013 on this company. I don't know if that's when it went public or what, but earnings were like $1, $1.10, $1.25, $1.50. Oh, excuse me, that's dividends. The earnings were 319, 358, 360, 555, and then 566. So that would that for that period of time that would qualify it as what I would consider a very steady growth stock. Then in 2018, earnings fell to 476. That was an 18% drop. Then they fell a further 12% in 2019, and this is your currency. And then in 2020 they grew by 26%, and in 2021 they grew by 33%, and that was coming out of COVID, the COVID era, and the stock, was it kind of bottomed at that point at around 10,000. No, I'm sorry, excuse me, at $84, 84.40, and then it just with the earnings growth accelerating to 26%, 33%, and 29%, it ended up getting a much higher multiple than it deserved. I'm joking again. And the PE got up to 37, excuse me. And then from that time, that was in March of '07. And then from March of '07, you know, um, the stock was trading at that peak valuation. And by October of 20, this was, excuse me, August of 2021, it peaked. By October of 2022, it fell 45%. And at that point, Mr. Valuation would have said buy it. It was trading, almost perfectly. It was trading at a multiple of 14.6, a PE ratio, which is below my 15 threshold. And, that was at a price point that I felt was very, very attractive. It was $124 or 124 NOK, whatever that is again. And that would have been a great time to buy. Now, since then, it's risen again, and it's gotten to me, slightly ahead of itself. But it's averaged almost over a 30% annualized rate of return, from October 2022 through yesterday's close. But I do think it's overvalued. And when the stock gets overvalued like that, I call it false profits. And, it's simply meaning that the stock is trading at a higher value than it should. But once again, with a margin of safety, I'd like to see it again as a 15 multiple, which it is historically traded at quite often. In fact, normally, I would say. The actual average PE since inception is 17, but there were the years like, for example, in 2013 and so on, it was trading at 8, 9, 10 multiples. It was trading at 11 multiple in 2016, trading at a 13 multiple in 2018. It was just that one spurt there where it really got highly valued. Then it came back down to a 15 multiple, and now we're trading again at a 21 multiple, which is slightly more than fully valued, but a great company, and it looks really interesting. Has low debt, 28% debt to capital. So this is the kind of stock, if you catch it at the right value, you want to back up the truck. But I don't think it's quite there right now. I think it's just a little bit overvalued for my taste anyway. But I'm really, really strict with valuation. I do want to keep that in mind. That's why they call me Mr. Valuation.
Okay, thank you very much, Chuck, for those quick overview of the companies. May I ask, when you look at serial acquirers, what kind of parameters do you use? Because PE ratios isn't the best parameter to use.
Well, because of accounting convention, you get a serial acquirer, and that's why this investor AB that we talked about in the beginning. That's why you see such an erratic change in their earnings. If I dug deeper, I suspect if I went into their financials, there's gonna be a lot of depreciation and a lot of non-cash charges and write-offs and so on going in as they make these acquisitions. So that is true. So from that point of view, when you're looking at those kind of companies, a metric that I think you could fall back on with some comfort, but it's still also going to be somewhat erratic, and that would be price to sales. Because now, looking at bottom line, which ultimately leads to top line, would become a valuable exercise. Let's put it that way.
Yeah, nice.
Again, dividends, you can use earnings yield or dividend yield. You want to buy the stock when, one of the things we have on Fast Graph is an overlay that you can, put on the graph, and it shows when the yields are the highest and when the yields were the lowest. And guess what? The yields are always the highest when the valuation is the lowest, and the yields are always the lowest, the dividend yields when the valuations are the highest. And again, it serves as a guide. There's no perfect answer to, investing is not a game of perfect, as I always say, but you want to try to be reasonable and you want to try to be prudent as you can, because, and by the way, I should say this in this podcast, every bull market ends with a bear market, and every bear market ends with a bull market. Now, the good news is, historically, at least in the US, that I know mostly about, bull markets tend to be long lived and measured in terms of years. Bear markets often are measured in months or at least or only quarters. The one in 2008 and 09 that we had here was what, 13, 14 months long. And it was the longest we had since, the Great Depression of the 20s and 30s. And so my point is that, we are long in the tooth, as the old saying goes, on markets on a lot of these stocks, and valuations that got extended. And, I'm not an international expert as much as I know the US, but certainly in the US, that's the case. And for what I've seen so far, looking at international stocks, I think there's a lot of value, high value across. So people need to be careful of being geniuses in a bull market. And this bull market has lasted a very long time. At some point, the dam's got to break. But again, they don't ring a bell, and I wouldn't even venture to guess when that might occur. But there'll be some catalyst, that's going to be long lived, not even like a COVID, something that's going to be long lived. That meaning long lived, meaning it's going to last more than a couple months, like COVID did, from a standpoint of really impacting economics.
And back to when you asked about our currency in Norway, we have it's called norske kroner in Norwegian, and the thing is, it's one of the poorest currencies in the Western world at the moment. It's a hot topic on the podcast, and for us retail investors investing in the US and Canada, we have seen a depreciation in the Norwegian krone about 50% since 2020. So how are your views for retail investors who earns their money in such a weak currency? Should we look at the currency how how would you attack that issue, if you know what I mean? Because every stock, even with corrections, would be expensive to us.
Yeah, well, yeah, it comes down to knowing what you're looking at, and doing your research. And there is no, by the way, there's no shortcuts, including F.A.S.T Graphs. I like to say it's the first step under a more comprehensive research and due diligence, and process, if you will. And so you've got to take all those factors into consideration. That's why you go beyond looking at simply the graph that we produce, which is, a very quick way to determine whether it's a good time to be an investor in a given stock or not. But you don't want to be um, all in on anything without weighing all the issues that you're going to face. And currency fluctuations are one, but again, you weigh them. What's been the trend, how they stacking up against other currencies, and how they going to affect the ability of the company to generate adequate returns for you in the future. But again, investing is not a game of perfect. You can only do the best you can. In fact, Libby, I'd like to share that Warren Buffett quote, because while we were talking here, I found it, because I think it speaks to this as well as it does to a lot of the other subjects that we've talked about here. And this was a quote that he made, I think, in 1974, and this was out of an article that was in Value Walk that somebody named Chuck Carnevale wrote. Okay, and let me see if I can find it. The whole quote. Here's the whole quote. Warren said, "We will continue to ignore political and economics forecasts, which are an expensive distraction for many investors and businessmen." Now, keep in mind when he said this. 30 years ago, no one could have foreseen the huge expansion of the Vietnam War, wage and price controls, 2 oil shocks, the resignation of a president, the dissolution of the Soviet Union, a one-day drop in the Dow of 508 points, or Treasury bill yields fluctuating between 2.8 and 17.4%. There's your interest rates. But surprise, none of these blockbuster events made even the slightest dent in Ben Graham's investment principles, nor did they render unsound the negotiated purchases of fine businesses at sensible prices. Imagine the cost to us if we had let a fear of unknowns cause us to deter or alter the deployment of capital. Indeed, we have usually made our best purchases when apprehensions about some macro event were at a peak. Fear is the foe of the fattest, but the friend of the fundamentalist. And the whole moral of the story is you got to weigh everything that you can look at. And if there's going to be issues with currency, you still want to mind your own business. How's the business going to perform? Regardless of things like currency fluctuations or changes in interest rates or any other macro event that might occur. How's the business and how well is it managed and what is their moat, and what's the sustainability of their product or service that they offer, and make your judgments based on those kind of things. And don't let these other exogenous things come into play too much. Consider them, weigh them, evaluate them, but don't let them quote unquote deter you or alter the deployment of capital, because ultimately you want to invest in good businesses at sensible prices, as Buffett taught us.
That's excellent way to, I think, conclude this episode, everyone. Mr. Chuck Carnevale, Mr. Valuation. We greatly appreciate that you took the time to speak with us. huge thanks from us and the community. Yeah, I would like to recommend everyone to check out your videos on YouTube. They are a masterclass of valuation methodology, and yeah, if people want to learn, we really recommend that. So thank you very much for talking to us, Chuck. It was a great pleasure.
Thanks for having me. It's been fun. I've enjoyed it. I hope you did.
Yeah, we certainly did. And Chuck, listen, I hope you enjoyed it as well. I know you perhaps get a lot of requests and people. I know you have over 140,000 subscribers on YouTube as well. So you're a popular guy. So I really wanted to thank you and Polly as well for her quick answers and the correspondence on email as well.
Thanks. I'll pass it on to her. She'll like that. She'll appreciate that.
Yeah, sure do, Chuck. And may I ask you one more question before we conclude this episode? Because we always ask our guests what they want us to call the episode. If you have any thoughts about that.
Well, I have my long quote: measuring performance without simultaneously measuring evaluation is a job half done. So I would love to see it titled something in the order of the importance of valuation, or, valuation matters and it matters a lot. That would be
Yeah,
my input.
yeah. But I was thinking about the valuation matters with Chuck Carnevale. That would be nice.
Yep. I'd like to see that. What I'm passionate
great.
about, as I hope
Super,
that
Chuck.
comes through. All right, guys. Is that it?
Yeah, that's it, Chuck. We wish you all the best, and
And like,
I hope you'll pass the compliment to Polly as well.
I will. I certainly will, and I know she'll appreciate it. Thanks, guys.
Thanks. Bye, Chuck.